I have spent most of my life watching Wall Street manufacture complexity. Every few years, someone arrives with a new financial miracle, a structured product, a hedging strategy, a mathematically elegant promise, a portfolio design so sophisticated that ordinary people are made to feel almost irresponsible for not understanding it. The brochures are glossy, the language is polished, the fees are hidden in plain sight, and the story is always the same. This changes everything. Usually it changes one thing: it enriches the seller. I have seen derivative products that look brilliant in calm periods and useless when investors needed them most. I have seen hedge fund strategies wrapped in the language of certainty and undone by ordinary reality. I have seen structured notes so complicated that the prospectus might as well have been written to intimidate rather than to explain. In good times, complexity flatters the people offering it. In bad times, it exposes them. That is why I have always preferred simple structures with honest economics. The most important financial innovations are rarely the ones that sound futuristic. They are the ones that lower cost, broaden access, remove unnecessary friction, and let ordinary people participate in productive capitalism without needing a private banker, a complicated opinion, or a PhD in financial engineering. That is why I take exchange-traded funds seriously. Not because they are glamorous, because they solved a real problem for generations. The advantages of diversification, low cost, tax efficiency, and systematic access to productive assets were enjoyed mostly by large institutions. Wealthy families and pension systems with scale. Today, a schoolteacher, a plumber, a nurse, or a young couple with a brokerage account can buy much of the same broad market exposure that giant institutions use, and do it with almost absurdly low friction. That is not a small improvement. That is one of the most useful financial revolutions of my lifetime. Now, before I go any further, let me tell you what I am not saying. I am not saying an ETF is magic. I am not saying every ETF deserves your money. I am not saying people should buy things they do not understand simply because the ticker looks respectable. An ETF is just a wrapper. The real question is what lives inside it, what job it performs, what risk it carries, and whether it helps you build a portfolio that can survive not just one good year, but a difficult decade. That is what I care about. And if I were building a practical ETF portfolio for an American household in 2026, with all the conditions we now face, I would not play games. I would keep the structure direct, intelligible, low cost, and durable enough to hold through inflation pressure, interest rate uncertainty, geopolitical friction, technological upheaval, and the many emotional temptations that keep ordinary people underinvested, overconfident, or badly misallocated, because that is the real problem in front of most Americans. They are not only behind, they are mispositioned. They hold too much cash in places that guarantee silent loss after inflation. They chase excitement in meme stocks and digital fantasies while neglecting slow compounding. They become concentrated in one country and then call it patriotism. They avoid bonds because bonds look boring. They ignore real assets until inflation reminds them that paper can lose purchasing power while buildings, land, and useful enterprises keep resetting higher. Most of all, they keep waiting for rates to fall, waiting for markets to feel safer, waiting until they have more money, waiting until they know more, waiting until the opportunity looks obvious. That is how people miss decades. If you are serious about building wealth, you need a structure that can begin now and keep working through conditions that will not always feel comfortable. If I were designing that structure today, I would want 5 things in it. I would want a broad claim on the productive power of American business. I would want real ownership outside the United States, so that my future is not fully tied to one country's leadership or one currency's behavior. I would want bonds not because I need excitement, but because I need ballast and buying power during panic. I would want exposure to tangible, real assets that can benefit when money itself becomes less trustworthy. And I would want a sleeve of high-quality cash, generative businesses that can keep paying me while the market is busy scaring itself. That is the structure I trust. And if you force me to express those 5 things in ETF form, here is where I would begin. The first ETF I would own is the Vanguard Total Stock Market ETF, Vermont I. This is the bedrock. When I was younger, I loved looking at individual companies. I still do. Reading annual reports, studying business models, understanding capital allocation, and comparing management quality were not chores to me, they were pleasure. That habit served me very well. But it also taught me something humbling. No matter how certain you feel about a specific company, individual businesses can surprise you. They can make poor acquisitions. They can lose discipline. They can be disrupted. They can be regulated. They can face technological shifts nobody priced correctly. They can be led by smart people into dumb outcomes. The broad market solves that problem in the only way broad markets can solve it. When you own VTI, you are no longer betting your future on the survival of one management team, one industry cycle, or one clever thesis. You own nearly the entire public corporate landscape of the United States. You own the giants and the upstarts. You own firms that are thriving now and firms that may thrive later. You own businesses that solve different problems for different customers in different economic environments. That matters more than most people appreciate, because the American economy is not one thing. It is an adaptive network of innovation, failure, reinvention, capital formation, and practical problem solving. The exact leaders change. The system itself remains remarkably productive over long stretches. New companies appear, old companies fade. Some are acquired, some fail. Some grow large enough to matter globally. VTI keeps shifting with that reality without asking you to forecast the next winning sector or the next blockbuster initial public offering. This is one reason I like broad low-cost market exposure for ordinary investors. It turns prediction into participation. And participation, if done patiently, has historically been a very good bargain. The United States remains unusually strong in several categories that actually matter for long-run wealth creation: technology, healthcare, innovation, financial infrastructure, consumer platforms, industrial reinvention, entrepreneurial formation, research, capital markets depth. None of these advantages guarantee a straight line. They do make the overall productive machine a very sensible thing to own over time. Then you look at cost. Here, VTI becomes almost ridiculous in a good way. The expense ratio is about 0.03%. For every $10,000 invested, the annual fee is about $3. That is not a typo. $3. There are people paying more than that each day in hidden financial friction because they never bothered to examine the cost of the products they were sold. Over 20 or 30 years, keeping those fees microscopic can be worth a fortune. Most investors do not understand how much of their future is quietly consumed by management costs because the fee looks small in year one. Compounding does not think in year one. Compounding thinks in decades. A bad fee is a leak that gets larger as the base gets larger. A low fee is one of the simplest forms of self-respect an investor can practice. If I were building from scratch Vermont, I would likely be the largest piece of the portfolio. Not because America is flawless, because broad American business ownership remains one of the strongest engines of long-run wealth creation available to ordinary people. Now here is the mistake many investors make after buying VTI. They stop. They look at the last decade and decide the lesson is that America is enough. That is recency bias masquerading as wisdom. The second ETF I would own is the Vanguard Total International Stock ETF, VIXUS. I know the argument against it because I have heard it from intelligent people for years. International stocks have lagged the United States. The American market is deeper, stronger, more innovative, more shareholder-friendly, more profitable, more everything. Some of that is true. It still does not mean you should own only one country's future. The most dangerous periods in investing often begin when one region has been so strong for so long that investors start confusing outperformance with destiny. They look backward and then quietly assume the road ahead must resemble the road behind. It rarely does. If you study market history honestly, no country or region owns permanent superiority. Leadership rotates. Different decades belong to different geographies. Japan had extraordinary periods. Emerging markets had periods when they dramatically outpaced the United States. Europe has had stretches of strength. Commodity heavy markets have had moments where inflation and real asset exposure made them far more attractive than people expected. This is not a philosophy point. It is what actually happens. When you own VIXUS, you are not making a heroic call that some one foreign market will become the next global winner. You are doing something much more practical. You are refusing to tie your entire equity future to the assumption that America will outperform every other region in every meaningful decade ahead. That is called diversification. Not symbolic diversification. Real diversification. VIXUS gives you exposure to developed markets and emerging markets outside the United States. It gives you companies in Japan, Germany, France, the United Kingdom, Switzerland, India, Taiwan, Brazil, and many more places. It gives you access to industries and business models that are less represented in the U.S. market: luxury goods, European industrial excellence, Asian manufacturing leverage, selected resource exposure, global consumer brands, local financial systems, pharmaceutical leaders outside the American umbrella. There is another reason I like international exposure, and it is one that ordinary Americans often ignore because their financial life is too local. Currency: if all of your assets are denominated in dollars, all of your future is priced through one monetary lens. If the dollar remains strong, fine. If the dollar weakens over time because of debt, deficits, policy, or simple long-term purchasing power erosion, then international holdings provide a natural partial hedge. When foreign assets are measured back into a weaker domestic currency, their value can rise even if local market performance was only moderate. That is not a reason to predict dollar collapse. I do not spend much time on theatrical macro prophecies. It is a reason not to tie your entire life to one unit of account, simply because you happen to live inside it. Then there is valuation. This is another point that serious investors should not dismiss. International equities in aggregate have often traded at lower price to earnings multiples than comparable U.S. exposure in recent years. That does not guarantee immediate outperformance. But if you can buy future earnings at a discount relative to what investors are paying elsewhere, you improve your odds over long spans. I like improving odds. I do not need a promise. I need a slightly better bargain. VEXUS also remains inexpensive relative to many actively managed international products, with a fee around 0.12%. That is still extremely low given the breadth of the exposure. If VTI is the home country growth engine, VEXUS is the hedge against home country overconfidence, and over decades, that can matter more than the crowd imagines. The third ETF I would own is the Vanguard Total Bond Market ETF BND. Now here I can already hear the younger investor objecting: bonds are boring, bonds are for old people, bonds are where ambition goes to die. I understand that emotional reaction. It is also one of the costliest emotional reactions in all of investing. The purpose of bonds in a portfolio is not to make you feel young. It is to keep you rational. That is a very different purpose, and a much more valuable one. What most investors do not appreciate until they have lived through a few genuine declines is that the portfolio does not break because the spreadsheet looked imperfect. It breaks because the owner could not stand the feeling of watching all the lines go down at once. That is the real danger: panic. And bonds, when used correctly, are anti-panic instruments. They serve two critical functions. First, they stabilize. Second, they generate ammunition. Those two things are more valuable than most people realize. When stocks fall hard, high-quality bonds often behave differently. In many ordinary fear episodes, investors flee towards safety, and that supports treasuries and broad bond exposure. The result is not that bonds make you rich overnight. The result is that they make your total decline smaller. That matters enormously because a smaller decline is not just a better statement number. It is an easier emotional experience. Easier emotional experiences produce better decisions. The investor down 40% often behaves very differently from the investor down 18%. Even if both theoretically know the same long-term truths, behavior is part of return. The second function is even more powerful. If your bonds hold up or even rise during equity stress, you can rebalance. You can sell some of what held value and buy what was marked down. That forces the one behavior investors always claim to admire and rarely execute properly on their own. Buying low. The reason this matters so much in 2026 is that bonds are not what they were during the ultra-low rate era. For years, bond yields were so suppressed that many younger investors concluded bonds had no real purpose. That was sloppy thinking. Even then, their stabilizing role mattered, but now the income is meaningful too. BND yields around the mid 4% range in the source material. That is real income. That is not zero. That is not decorative. That is a serious component of a disciplined portfolio, especially for anyone near retirement, anyone living partly off income, or anyone who simply wants the structure that allows him to keep buying when the market becomes emotionally ugly. Content reference: OASite. One FAIND also brings enormous diversification within fixed income. You are not trying to guess one bond issuer. You are not becoming a tiny credit analyst with excessive confidence. You own broad U.S. bond market exposure across treasuries, agency-backed securities, and high-quality corporates. And again, the cost is almost microscopic for a younger investor. Maybe bonds are 20%. For an older investor, perhaps much more. The exact percentage depends on temperament, age, need for income, job stability, and how much pain a person can endure without doing something foolish. I do not pick one bond allocation for all people. I do insist that ignoring bonds entirely is often less a sign of courage than a sign of inexperience. Now let us move to the fourth ETF, because this is where modern investors often become strangely vulnerable. They know inflation exists. They complain about it constantly. Then they build portfolios as though inflation were someone else's problem. That is a contradiction. The fourth ETF I would own is the Vanguard Real Estate ETF. VNQ Real Estate, in the broad investment sense, is one of the few categories that can combine current income, hard asset backing, and some degree of inflation participation. I am not talking about the romantic fantasy of owning one rental house and calling yourself a mogul. I am talking about diversified public exposure to income, producing property types that remain useful regardless of what the current social narrative happens to be. Warehouses, data centers, cell towers, apartment complexes, medical office, industrial properties, retail with the right economics. These are not merely buildings. They are claimed structures on recurring human activity. And when money loses purchasing power, the owner of a useful real asset is not always helpless. Rents can adjust, replacement costs rise, scarce. Strategically located assets often become more valuable in nominal terms because the cost to recreate them increases along with everything else. That is why I like having some real asset exposure in a portfolio designed for uncertain inflation, policy drift, and long-term currency erosion. VNQ gives you diversified REIT exposure in one low-cost wrapper. Instead of trying to pick one property theme or one heroic landlord story, you own a broad slice of public real estate. That is much cleaner. It keeps you from confusing your neighborhood instincts with portfolio construction. And importantly, REITs bring income. They are required to distribute a large share of taxable income, so the yield matters. It gives the investor cash flow from an asset category that sits closer to the physical economy than pure paper claims. In periods where inflation is sticky and money itself becomes less flattering as a store of value, this sort of exposure becomes much more interesting. People make a mistake here too. They hear real estate and assume housing. I do not mean that. Your primary residence is not the same thing as public diversified real estate exposure. One is a lifestyle asset with concentrated local risk and maintenance burden. The other is an income producing portfolio slice spread across many property types and management teams. That is a much more useful financial tool. If VTI is productive business ownership and BND is stabilizing dry powder, then VNQ is a bridge into the tangible economy. And in a world still wrestling with inflation, supply disruption, and the repricing of physical scarcity, I think that matters. The fifth ETF I would own is the Schwab U.S. Dividend Equity ETF South Carolina HD. This is the one many investors misunderstand. They hear Dividend ETF and assume it must be for retirees, or for people who do not understand growth, or for people who are secretly afraid of technology and progress. That is not how I think about it. I think about quality of cash generation. A company that has paid and sustained dividends over long periods is not automatically wonderful. But it has passed one basic test. It has generated enough real cash over enough time to send some of it back to owners and keep doing so. That matters. In uncertain markets, cash-generative, disciplined businesses often behave differently from glamorous stories whose value lives mostly in expectations. CAG has historically screened for strong dividend payers with solid profitability and balance sheet characteristics. It tends to lean toward mature cash rich businesses rather than the most speculative corners of the market. That gives it a very particular role in a portfolio. It adds quality tilt, it adds income, and perhaps most importantly, it adds emotional staying power. People underestimate the emotional role of dividends when you own pure growth exposure, and the portfolio falls. All you have is a smaller number on the screen. When you own Dividend, paying businesses, you are at least receiving cash while the market does its usual impression of instability. That does not erase drawdowns. It does make them psychologically easier to endure for many people. Psychology matters. If dividends help you stay invested, they have done something extremely valuable. The source document leans into this point, and I think it is correct to do so. Cash arriving quarter after quarter changes how many investors experience volatility. It gives a sense that the enterprise is still working on your behalf, even while Mr. Market is acting dramatic. Contenter Frenzoea site, 2-Fe index Fe 2-Fe now, I would not build an entire life around yield chasing. That is another beginner's mistake. If yield becomes the religion, people end up buying weak businesses with attractive payout numbers and poor economics. I do not want that. I want quality cash flows. I want businesses that can still fund the dividend because the underlying enterprise is durable. That is why Shiji, as a rules-based quality dividend exposure, earns a place for me as a finishing layer rather than a whole philosophy. So if you step back, here is what these 5 ETFs are really doing. VTI gives me broad, productive power. VEXUS gives me global diversification and a hedge against home country. Overconfidence BND gives me stability, income, and rebalancing ammunition. VNQ gives me real asset exposure and inflation, linked economic relevance. SAG gives me quality cash flow and emotional endurance. That is a serious portfolio framework. It is not built for cocktail party storytelling. It is built for surviving the real world. People often want to know the exact percentages, as if precision itself creates wisdom. It does not. Still, if I were sketching a practical starting framework for an ordinary investor in 2026, I might think something like this. A core majority in VTI, a meaningful but smaller allocation in VEXUS, a serious stabilizing sleeve in BND, a modest real asset sleeve in VNQ, a modest quality income tilt in SHD. The exact balance depends on age, temperament, and whether the investor needs income now or is still in full accumulation mode. A younger aggressive investor might keep VTI and VEXUS heavier, BND lighter, and use VNQ and SHD as smaller tilts. A later carrier investor or retiree might raise BND and SHG meaningfully because income and stability now matter more than maximum theoretical upside. This is what portfolio construction should look like, not one-size-fits-all slogans, not constant activity, appropriate exposure to different economic roles. Now let me say something about timing, because this is where people do the greatest damage to themselves. They hear about 5 sensible ETFs and immediately begin asking whether now is the right time. Should I wait for a pullback? Should I buy after the next Fed move? Should I phase in over months? Should I hold cash until the election? Should I wait for the market to feel better? These are ordinary questions. They are also often expensive questions. The perfect entry point is an idle people worship because it gives them permission to delay. I do not believe in delay as a wealth strategy. I believe in structure. If you have a lump sum and you are too anxious to deploy it all at once, fine phase in over a short predefined period. That is a temperament solution, not a return. Maximization theorem. If you are starting from income, even better. Automate monthly contributions. Let the machine run. Stop interviewing your emotions every payday. Because this is the final point I want to make. The greatest advantage of ETFs is not only diversification, it is that they allow you to build a system stronger than your moods. Most investors do not lose because their fund choices were terrible. They lose because they interrupt the process. They chase what recently went up, they abandon what recently disappointed, they stop buying during drawdowns, they restart after recoveries, they confuse activity with intelligence. A good ETF structure will not save you if you keep sabotaging it. But if you combine the right structure with the right behavior, then something powerful begins to happen. The noise matters less. You stop needing to forecast everything. You stop pretending you know which sector wins next quarter. You stop trying to outguess every rate move. You start owning large, sensible pieces of the world and letting time do what time has always done for patient owners of productive assets. That, in my experience, is how real wealth gets built, not through brilliance every month, through rationality for a very long time. So if you ask me what 5 ETFs every American should own in 2026, I would not answer with a fashionable list of excitement. I would answer with a structure. VTI for the broad American engine, VXU, so America is not the whole story. BND so panic does not become policy. VNQ so inflation and physical reality are represented. SEG so quality cash generation remains part of the machine. Then I would tell you something even more important in the list. Buy them in a sensible proportion, automate the additions, rebalance occasionally, keep costs microscopic, and stop waiting for the world to become easier before you begin. The world was never going to become easier. That is exactly why the structure matters now.